Okay, folks, so we have three violent things to discuss today. Number one, I want to talk about the latest on the short squeeze stocks and what happened today. Number two, I want to give an update on Ooga Booga AMC. And lastly, I want to talk about something huge that the SEC just said that relates to retail traders and especially Robinhood's business model. And the only thing that I ask in return for all of this is that you hit that ravishing like button, and also don't forget to subscribe either. Okay, let's go ahead and start with SPRT. So SPRT had quite the pre-market gap up, 28 to 38 this morning before cooling off the rest of the day. And as we were talking about yesterday, an upcoming catalyst vote on merger with Greenridge is happening on September 10th, which is next Friday. SPRT also has a ton of short interest. But here's where it gets interesting. You look at their failures to deliver, massive spike towards the last 7 trading days of July. July 22nd and 23rd's failures to deliver corresponded with due dates on August 27th and 28th, which was last Thursday and Friday when it started going parabolic. But only about 900,000 failures to deliver came due on Thursday and Friday last week. A lot more are coming due this week. We now have that massive jump from July 26th of 896,000 failures to deliver, July 27th, 890,000, July 28th, 655,000, July 29th, 258,000, and of course July 30th of 885,000 whopping failures to deliver. And when are they coming due? Well, thank you for asking. Tomorrow, Wednesday, Thursday, and Friday, which of course is a looming catalyst, and you combine that with the merger catalyst coming up in terms of a vote on the 10th, and then whenever it actually goes through. And you have a lot of different catalysts here. Now remember, when you fail to deliver on something, you do eventually have to deliver on it. You have a set amount of time for which you have to go and either buy or borrow that share in order to deliver on it. So generally, a massive amount of failures to deliver coming due is a fairly bullish event. It's also true that whenever a heavily shorted stock rallies massively, you get a massive increase in failures to deliver, because if short sellers were shorting without actually having the shares to back it up, then they're going to be called BS on that very quickly. But when you consider that a rising share price is one of the risk factors associated with a massive increase in failures to deliver, well, it suggests really strongly that the current rally that we just came back from likely also is going to result in a massive failure to deliver report when that comes out, which those will come due at the end of September, closer into October. It's also true that SPRT has a bit of a cult following, and it's growing. SPRT holders call themselves Spartans. Now, I hope that they don't end up like the Spartans at the end of the 300 movie. But the fact of the matter is the Spartans were a pretty damn fierce group of people. And in all seriousness, when it comes to meme stocks, one of the best ways to tell which meme stocks are going to continue to be players months down the line is specifically whether or not they have a massive stubborn cult following behind them. That's what happened with AMC. That's what's happening with GME. And because you have such strong strength in those numbers, and people are like, every single time it goes down, they're like, I'm not selling, hodl. And at the same time, you have stubborn short sellers who are like, hey, I'm not covering, hodl. Cult mentality on both sides allows it to stagnate at much higher prices than would reasonably be accepted under the company's fundamentals. Now, in terms of predictions, when it comes to something like SPRT, I do believe there's going to be another round of moves. I just hope it starts from a much lower price point, say $10, $15, instead of forcing a rally now at these levels. Okay, our BBIG play was fun. It ran as high as 10.59 before capping off a switch into a downward direction below our red directional SMA, and it failed to consistently break above that all day. Some pops here and there, but overall, most of the run was in the pre-market. It appeared on our radar on the briefing at about $3.40 a share Friday morning, and the idea that meme inflows can cause a play like this to 3x in 2 trading periods is complete insanity, and I love this. This is the definition of getting yourself in the right place at the right time. This is stock that had and still continues to have incredibly high short interest, and this is what happens when you're a short seller and you get overly aggressive with stocks. You do everything you can to get the stock down to 0, and then all of a sudden people start calling your bluff on it and saying, hey, wait a second, you just left yourself overly exposed. Smart money was really adamant on getting this down and getting it down fast. Unfortunately for them, it went completely the opposite way. You already know that I have a Hedge Frontiers mug, but now I'm starting to think I should have bought a bucket. Moving on, so this morning we talked about KPLT. KPLT was pretty fun. We said selling off from retail-induced buy storm, watching for a bottom and reversal above red directional SMA line, possible healthy run if we can get holding above that, especially after open. That is what happened. We watched for a bottom. It ended up bouncing just above the red directional SMA line at 4 and held throughout the day, rallying to nearly 6. My thought process was this was largely a sympathy run based on 2 fronts. On one front, you had an associated company AFRM run up on an Amazon partnership, and KPLT was running up in sympathy to that. On the second front, the frothy market for meme stocks has allowed for a lot of sympathy runners in pretty much any momentum stock right now. If something catches fire a little bit in the pre-market, you see a lot of people pouring into it thinking that it's the next squeeze stock, even if its short interest isn't even that crazy. Anyways, continuing to watch this one, but moving on. Okay, Ooga Booga. A pretty solid green day for the AMC Oogas out there. You've certainly seen a huge comeback of meme momentum stocks the last few days, and AMC and GME have continued to benefit from that. There's an idea in the retail community that a lot of other short squeeze stocks are running up specifically so that hedge funds can distract you from AMC. And some people believe that AMC is actually a distraction itself from GME. But of course, it is worth mentioning that there's not a centralized hedge fund Illuminati that is trying to coordinate everything. There's actually a lot of different hedge funds that are all attacking each other. Now, there are some massively big hedge funds in the market that have a lot of undue influence over a lot of different things. But I think that what more so is happening here is that a lot of individual short sellers are going overly aggressive at short attacking a lot of stocks. And at the same time, retail traders themselves are becoming their own hedge funds essentially, by realizing that by coming together and doing due diligence, they can all individually partake in a lot of these high short interest stocks that can then induce a squeeze. So what's happening is that, yes, you have a lot of hedge funds that are ganging up on certain stocks. You have other hedge funds that are attacking them, and you also have retail that is attacking a lot of high short interest stocks. Well, you also have to look at the numbers and say, hey, wait a second, if a short seller gets crushed and loses tons of money on SPRT and BBIG, well, that's less power, capital, and authority to ward off margin calls and pay margin fees on stocks like AMC. It also makes short sellers more and more desperate every single stock they lose. And don't be fooled either. There's hedge funds behind the scenes that are making money on the long side on this, back in retail traders where it's convenient to them. But I think that when it comes to that narrative of, oh, these stocks are running up to distract people from AMC, that's a bunch of hacky-sacky. Okay, lastly, I want to talk about what the SEC just said. So Chairman Gary Gensler, just went on Barron today and said that the controversial practice of banning payment for order flow is, quote, on the table. Now, I know that this is something that a lot of people have wanted in the retail community, and people are probably really happy to hear that this is even an option. And this is almost certainly a direct result of a ton of pressure coming from retail communities and the SEC hearing out what retail has to say. Payment for order flow and the entire order flow system needs to be intensely looked at and fixed. But never forget, they say the scariest words in the English dictionary are, I'm from the government and I'm here to help. Banning payment for order flow doesn't solve the core issue here. When you ask the average retail trader of why payment for order flow is bad, they say, well, because it empowers and gives an unfair advantage to hedge funds and market makers that get to fulfill our orders. Which is damn true. But banning payment for order flow doesn't fix the order flow part of the equation, which again is what I just mentioned. Non-payment for order flow brokers and payment for order flow brokers overwhelmingly route their trades to the same market makers. We made a video a few weeks back breaking down the pros and cons of payment for order flow and some of the challenges and how it can be fixed. I'll link to it below, but basically we talked about how payment for order flow brokers and order flow brokers still have the same core issue, which is the high potential for corruption in the order flow part. It's just that in one situation, the broker doesn't have any monetization structure, and in the other one, they do. Obviously, a lot of people get upset about certain hedge funds and market makers, which we won't name. They'll get upset with them and say, I don't want my broker getting any kickback from working with them. And then they'll say, but it's okay if my broker works with them for free. By outright banning payment for order flow instead of giving individuals a choice at where they route their trades to, you're only enriching market makers further and probably further concentrating the market makers' power. The ones with the biggest liquidity pools are going to be the ones that offer a very, very fast and efficient execution a lot of the time. By banning payment for order flow, you're allowing market makers to receive that order flow and profit off it and gain an edge over it without having to give a kickback to the broker, and you're gutting the broker's main revenue structure, which of course they'll pass on those extra costs to you. Before you go into banning payment for order flow, you have to figure out how to fix the system of order flow first. If you're a market maker that executes retail traders' trades, you have to create a fiduciary rule that keeps the parties more neutral. You have to increase regulatory oversight and reporting standards specifically so that you're making sure that those are being followed, and you have to make sure that they're fulfilling their obligation for best execution, at which case you build trust back in the system, and you can let retail traders choose between payment for order flow, regular order flow routed trades, and then going directly to the exchange. Banning payment for order flow without fixing the order flow part is a massive, massive waste of time. And it's likely going to drive up costs for retail traders like it has in countries like Canada and the UK that have done the same thing. Anyways, folks, that caps off the video. What do you think about this issue? Let me know below. If you'd like to learn how to trade with our step-by-step lessons, our private chat, and of course, our daily morning briefings where we brief on all the latest catalysts that we see each and every market open morning, well, I'll go ahead and put the link to ZipTraderU below. FUDStopper50 will get you $50 off before checkout. You just put the coupon code in the add coupon spot and you are golden. And if you're wondering what broker to trade these stocks on and you're looking for a day trade, a short-term trading broker, my suggestion is you try out Webull. Webull will also give you 2 free stocks if you sign up and deposit just $5 with our link below. Now, if you're looking for a longer-term broker and you're more of a buy and hold trader, hey, public.com is another great option, and I'll put a link to them below as well. Anyways, folks, that caps off the video, and I'll see you in the next one.